Larry Fink believes Bitcoin is an asset class all by itself. The Fed's Neil Kashkari says that Bitcoin is still worthless. And Michael Saylor believes that Bitcoin is digital algae. All of these sound bites are great, but I want to show you how you should only be paying attention to two $100 trillion asset classes to know that a recession is unlikely, and why, if you aren't already bullish on Bitcoin, you should be over the long term. Let's get into it. What's up, everybody? I'm Dante Cook with Bitcoin Simply, helping you to understand macro and markets in a simple way. Subscribe if you already haven't. We put out content 6 days a week on this channel, and today I'm going to be showing you just the two $100 trillion asset classes that you should be paying attention to help you filter out all of the noise and only focus on the signal. Let's go.
We think of it primarily as an emerging global monetary alternative, right? It is a scarce, global, decentralized, non-sovereign asset, and it is an asset which has no country-specific risk, has no traditional counterparty risk. So these are interesting properties when you think of it from an investment perspective, particularly in a world where there's growing concerns over money printing, currency debasement risks, political, fiscal, sustainability challenges in the U.S. or elsewhere.
That was BlackRock's head of digital assets, Robert Mitchnick. Over the past year, BlackRock has gone from Bitcoin skeptic to Bitcoin bull at the direction and directive of one man, Larry Fink, their CEO, the greatest market maker in the history of finance. Here's what he had to say to analysts about Bitcoin during their Q3 earnings release last week.
Well, first, I'm not sure if either president or other candidate would make a difference. I do believe the utilization of digital assets are going to become more and more of a reality worldwide. Conversations we're having with institutions worldwide, conversations about how should they think about digital assets, what type of asset allocation there should be. I mean, we believe Bitcoin is an asset class in itself. It is an alternative to other commodities like gold.
If that doesn't make you bullish, how about this? Yesterday, Bitcoin ETFs had inflows of 556 million. Fidelity had 239 million. Bitwise cracked 9 figures at 100 million of inflows. BlackRock, or IBIT, had 80 million in inflows, and ARK had inflows of about $70 million. All of the major players were positive in inflows, and this was the highest day of ETF inflows since June. And if that doesn't make you bullish, guys, we caught a rocket with chopsticks. And if that doesn't make you bullish, for the first time in 2 decades, there were not just one, but 2 white cornerbacks that started for NFL teams this past Sunday. Maybe the NFL should start running a white cornerback opportunity agenda and giving bonuses to any white cornerbacks that earn playing time. I'm just trolling here, but not really. Okay, back to Bitcoin. If this stuff hypes you up, this will really hype you up. In this latest clip from Michael Saylor with Andy Estrom and the On-Ramp team, he talks about Bitcoin's virality in that you don't really see its impact until it's already so big and growing at an exponential rate. He calls it monetary algae.
One of the first things they taught me at MIT about this was, they said, if you have a pond and there's algae in the pond and the algae is doubling every day, and in 30 days, it covers the entire pond, on what day of the month will you notice you even have any algae? And it's like, well, 90% of the days, you don't even know you have any. And like on the 26th day, you notice something. And then in 3 more days, the pond's completely covered, right? So with exponential processes, there's a whole lot of nothing apparently going on as the process builds and builds. And all of a sudden, there's a little blip. And then all of a sudden, you have more action. Like with Apple stock, right? It took forever, 40 years to make it to $1 trillion, and it took like 18 months to make it to $2 trillion. But you see that as a phenomenon. And that's the phenomena here, organically, virally spreading everywhere in the world, I think.
And then on the flip side, you have people that still don't see it, like Minnesota's Fed chair, Neil Kashkari, who said that Bitcoin is still worthless, even though it's over $67,000 a coin in US dollar terms as of recording this morning. And he should know better after making comments like this.
Can you characterize everything that the Fed has done this past week as essentially flooding the system with money?
Yes, exactly.
And there's no end to your ability to do that.
There is no end to our ability to do that.
And now on to my main point for today, because today is super bullish. All of the news, every clip, every tweet, everything you see coming out about Bitcoin is going to be very bullish. But on another day, there's going to be bad news. There's going to be a high inflation print. There's going to be talks of war. There's going to be some reason that's going to cause you to forget about the long-term trajectory and potential of Bitcoin. So what I like to do on Bitcoin Simply is help you filter out all of the noise so you can focus on the right things. Here's a larger macro framework to help you understand why you should be bullish on Bitcoin in the long term and why a recession is simply untenable right now in financial markets. A lot of people get caught up in these small blips that happen on a day-to-day basis, but I want to introduce you to a $130 trillion market, the bond market. This market actually controls the world. The largest and safest place for other countries to safeguard their assets in historically has been the US Treasury market, or the long bond. And increasingly, foreign countries are preferring to not put their trust and their faith in the United States Treasury. The share of U.S. Treasuries held by foreign countries has dropped from 33% in 2014 down to 22% today. Here's another chart showing the same thing. And what are they beginning to buy other than U.S. Treasuries? Well, hard assets like gold. This is one of the most classic charts in macro finance. It says that basically the long bond competes directly with gold. And if you invert the US long bond or the 10-year treasury note, what you see is that these things should be correlated. And when they diverge, it means that people are pricing something into the market. When you look at these charts, you see that people are preferring to store their long-term wealth and assets into gold versus United States treasuries. And as Larry Fink has said in previous interviews and in his Q3 earnings report, people all across the globe are betting on the U.S. fiscal policy not getting better, but getting worse, and needing to diversify into other assets. And largely, one of the assets that they're considering is Bitcoin. So you have $130 trillion flowing into a $50 trillion stock market, an $18 trillion gold market, and a $1.3 trillion Bitcoin market. So you have $130 trillion flowing into $70 trillion worth of assets. I think the value of the 70 trillion is going to go up relative to the 130 trillion. The trade is simple. Now here's my second point. There's another $100 trillion asset class that you should be paying attention to. And this helps me to understand that it doesn't really matter whether Donald Trump or Kamala Harris is elected. It's the fact that people 55 years and older control and own 74% of investable assets in the US, and the number is probably the same globally. This represents about $114 trillion worth of assets. This chart shows this well. In a recent University of Michigan report, it shows that the median value of stock portfolios in the United States is over $250,000, which means the rich keep continuing to get richer. The asset holders win in the long term. Do you think that the United States government is going to crush the portfolio values of boomers right when they're retiring and right when they're starting to withdraw these assets and spend them in the economy? Absolutely not. Luke Gromen talks about this in one of his recent podcasts, and he explains it very well.
People 55 years and older in this country have $114 trillion of wealth. They own 70% of the assets. And they are engaged in what we have called the world's biggest YOLO spending binge in history. YOLO, you only live once. So everywhere I go, everything's full. Everything needs reservations. And they're all people 55 years and older. So there's absolutely a bifurcation in the economy. Things are definitely slowing meaningfully at the low end. And they may actually be recessionary at the low end, except in an economy where the 1% are all that matters from a financial standpoint, the top 10%, right? From a financial standpoint, it's harsh, but it means you can't have a headline recession while those people are out spending money like they're going to die in 5 or 10 years, because the reality is demographic, actuarial tables say they are going to die in 5 or 10 or 15 years, and they can't take the 110 trillion with them. And so between this deficit of 8% of GDP, outlays growing at 10%, and then this YOLO spending binge of $110 trillion, that is basically this sort of tidal wave that is papering over a lot of other things in the economy that aren't really going so well at the low end, in housing, in commercial real estate, et cetera.
The Fed and the US government have three potential choices: default on their interest payments and therefore default on their currency, creating hyperinflation. The value of things in the stock market and other things would go up on a nominal basis, but it would cost you $1 trillion to buy a carton of eggs or a loaf of bread, aka Weimar Germany. Option number 2, they can cut entitlements in government spending and therefore cut the only thing that is propping up the markets right now. This would crush boomer spending and tax receipts as we know it. Or option number 3, they can print money, which is what they have done, which is what we think they will do and will continue to do at an increasing rate. So when the price of Bitcoin starts to respond to the stimulus that we've been talking about for years, it is highly sensitive to global liquidity and will rise as more money is printed into the system. But when that time comes, will you be prepared with the skills and the ability to take self-custody of your assets? Or will you continue to trust banks and governments to hold your assets? If you don't feel confident that you've mastered these skills, that you've mastered your privacy and your cybersecurity, well, head over to thebitcoinway.com. They have one-on-one cybersecurity specialists that will help you understand Bitcoin, take self-custody, and take control of your financial future. Schedule a free consultation with their team today at thebitcoinway.com. Let me leave you with one final thought. There's a great chart going around with the compounded annual returns of the greatest investors of all time. McKay had an 80% compounded annual return for 20 years. Joel Greenblatt, 45% for 19 years. Jim Rogers, 38% for 11 years. Stanley Druckenmiller, 37% for 12 years. But I think they missed out on the most important investor, the average or the regular Bitcoin investor, who has had a compound annual return of 161% a year for the last 14 years. By not being all that smart, just buy, hold, store, and secure your Bitcoin. Don't make it too hard. The trade is simple. Look at the hundreds of trillions of dollars of assets to help inform your long-term thoughts about Bitcoin and whether you think it will increase from $1 trillion where it is today. This is Dante Cook with Bitcoin Simply, signing off for the day. Happy stacking.